Hi, let's talk about an extremely important yet often overlooked concept when it comes to creating winning portfolios. Let's talk asset allocation. So, most of us have heard the term asset allocation, and more so whenever we are having a conversation pertaining to our own personal investments or investments of a loved one and the kind of portfolio that they have created. But quite often than not, people don't really lay the emphasis that is warranted on asset allocation and defining asset allocation strategies. So today we'll be diving a whole lot more deeper into the fundamentals and concepts of asset allocation and what are the different asset allocation strategies that can create winning portfolios. So let's start right from the basics. What is asset allocation? So asset allocation in very simple terms is basically a strategy that helps you decide the right assets and the right proportion that is required to optimize your final risk adjusted returns. It is to ensure that for every incremental unit of risk that you take, you are adequately compensated in terms of return, and this portfolio over a longer period has the ability to deliver relatively consistent and sustainable returns. Now that we have started talking about asset allocation, let's break this apart. Let's talk assets. So, what are the various assets that are available to a common investor? And the most popular ones include, obviously, number one has to be equities. Domestic equities, international equities, shares listed on the stock exchange. Second are debt instruments. It could be in the form of NCDs, debentures, bonds, or simply debt-oriented mutual funds. The other most popular form of fixed income securities, very prevalent and popular in India, also includes fixed deposits, or popularly known as term deposits, that are offered by several banks in India. The next asset could be gold. So gold, as we all know, India is among the leading consumers of gold. But at the same time, one must understand that although it is a metal that is being consumed in the form of jewelry or ornaments, it also has a value as an asset, right? So then there's gold. The most aspirational asset among millennials, at least right now, is real estate. It is an aspirational asset and it does definitely qualify as an asset. And as long as we are talking about aspirational assets, let's also talk about the cool assets. Cool assets include collectibles in the form of art, collectibles in the form of limited edition pieces, collectibles in the form of Bitcoin. Okay, so while most may argue whether Bitcoin is an asset or a currency or simply a medium of exchange, for now let us just classify it under the broader category of collectibles and see that how does it shape up in our broader asset allocation strategy. So these are the popular asset classes that are available to investors. These are then bundled and presented to investors in form of various products. So like we spoke briefly about debt could be in the form of bonds, debentures, debt-oriented mutual funds, a simple fixed deposit, or a sovereign bond, or an RBI bond. It could be any of these, but these are just instruments that fall under the broader umbrella of debt as an asset class or fixed income as an asset class. When we talk about equities, it could include direct shares or equity-oriented mutual funds or equity-oriented PMS products, that is portfolio management service products, or AIFs, alternate investing funds that invest into equity-oriented assets. So these are the variety of asset classes that are the most popular and comprise most asset allocation cases. So now that we've spoken about assets, let's move to the second half of asset allocation, that's allocation. So what does asset allocation try to optimize for? What does asset allocation try to achieve? So asset allocation basically tries to achieve risk optimized returns, which needs to be consistent and sustainable over a longer period in time. And how does it try to achieve this? By using a variety of assets in a certain combination to ensure that your investment or your portfolio achieves your goal in a rather predictable manner, in a tentatively predictable manner, as opposed to being absolutely volatile and susceptible to externalities. So that is what asset allocation tries to achieve. Now that we have spoken about asset allocation, let's jump deeper. Let's talk about the various strategies that portfolio managers employ while deciding an asset allocation framework. Let's begin with the most conventional one. The most conventional one is the one that relies on age or time as a primary metric to arrive at your asset allocation. So what does that say? Basically, it says that the younger you are, the more risk you can take, or the farther your goal is, the more risk you can take. So let's say if you're a young guy and you have a financial goal that is very far in time, let's say 25 years from now, you will be given an asset allocation framework which is extremely heavy on riskier asset classes. However, time changed, we realized that just age or time cannot be an input in isolation to decide an efficient asset allocation strategy. For example, a young guy could have certain financial responsibilities which brings his risk appetite significantly lower. Or at the same time, we may have someone who is almost retired but has so many multiple sources of income that he does not mind taking more risks than the average old guy. So given such personal attributes, the strategic asset allocation school of thought emerged. And now strategic asset allocation focuses a lot on your personal needs and your personal attributes. It started focusing on the personal in personal finance and recognizing the uniqueness of every individual's financial needs. So essentially, a strategic asset allocation focuses on deriving and creating an asset allocation framework bases your risk profile and your investment profile. So let's take a step back. Let's talk about what is a risk profile all about. So to put it simply, a risk profile is a culmination of two of your personal attributes. One, your risk-taking ability, and two, your risk-taking willingness. It is quite possible that you may have a high risk-taking ability, you have very limited liabilities, you have great income, you have significant investments and a very long runway. You may have great risk-taking ability, but what if you do not have the willingness? What if you do not wish to take that kind of an exposure that will put you through an extremely bumpy ride? What if you're someone who just does not like volatility, right? So that it is not just your ability in isolation or your willingness in isolation does not help create your risk profile. A combination of the two of this helps creating very efficient risk profiles. Now, this is one part. The second part is about your investment profile. We briefly spoke about deciding financial goals, right? So an investment profile basically revolves around the attributes of your financial goals. How far in time do you want to achieve your financial target? What is the amount that you want to achieve in that period in time? And several other attributes that are very specific to your investment preferences and your financial goals. So a combination of a risk profile and a financial goal-based investment profile will decide your strategic asset allocation framework. So under this framework, your final asset allocation is highly sensitive to changes in your personal attributes. So as you move towards being an aggressive investor from a level 1 conservative investor, your exposure will slowly and gradually increase towards riskier assets and decrease towards less riskier assets and vice versa. So this is about strategic asset allocation. However, there emerged another need wherein there were investors who do not want to create a portfolio just basis his risk profile or his investment profile, but wants to create a portfolio that will capitalize and optimize on every developments in the economy and the broader markets and the broader asset classes. And thus emerged tactical asset allocation as one of the asset allocation frameworks. So unlike strategic asset allocation that focuses a lot on you and crafting an asset allocation framework that suits within your framework and your needs and your persona and your attributes, tactical asset allocation focuses on the state of the market, the state of the economy, the outlook on several asset classes, and it tries to optimize across cycles. So this is called tactical asset allocation. So these are the three most popularly followed asset allocation strategies. A quick recap: the time/age based asset allocation, which focuses on the time horizon that you have left to achieve your financial goals. The second one is strategic asset allocation, that focuses on your personal risk profile and your investment profile. And the third one is a tactical asset allocation that tries to capitalize on evolving situations in various asset classes, in various market situations, and in various economic cycles. So this was a quick recap of the different types of asset allocation strategies that several portfolio managers employ. So now that we've spoken about the several asset allocation strategies, here are a few pointers that I'd like to share out of my personal experiences while managing several portfolios. So point number one, do not be afraid of experimenting. Be experimental, but do not let go of the concepts and the fundamentals. For instance, one of the portfolio management and asset allocation strategies that I like to use, I've nicknamed it the hybrid asset allocation strategy, uses a judicious mix of strategic asset allocation as well as tactical asset allocation in line with the investor's interests and investors' personal attributes. So that's one. The second thing that you need to recognize and understand is that every asset class is different. Ensure that you select a combination of asset classes in a way that it achieves the objective of diversification, risk minimization, and return maximization at the same point in time. Do not add asset classes without checking on its correlations. It needs to be weakly or less correlated to add more diversification value to the asset allocation that you have decided. Third, do not forget the review and maintenance part of asset allocation. No matter what strategy you choose, stick to it and ensure that you review and realign your strategy and your portfolio from time to time. So a few trigger events for you to review your asset allocation strategy or realign your portfolio with your target asset allocation is one, when there are any changes in your personal circumstances, or specifically personal financial circumstances, wherever there's a change in the need for cash flow or change in the income levels. That's when you need to revisit and reaccount for it. Two, whenever there is a drastic change in the external environment, let's say there is a drastic change in the outlook for a certain asset class. Let's say you have decided to assign a certain percentage of your portfolio to cryptocurrencies, but suddenly the regulations make it illegal and you have to move out of it. Please review your portfolio in light of such new information and ensure you are in compliance and alignment with your strategy and the regulations broadly. The next important trigger event would be any change in your financial plan. Okay, if there are any changes in your plan going ahead, if you decided to buy a certain thing, in the next 5 years, and now you have decided not to go ahead and buy it, please realign your portfolios and your asset allocation strategy whenever there is a change in your financial goal as well. It is extremely important to review, realign, and maintain your asset allocations and your portfolios in line with your asset allocation. There could be a periodic review calendar that you would have set for yourself. It could be either 6 months or 1 year. Do not overdo it, but ensure that your portfolio is sticking to the asset allocation that you have finally decided. Due to several movements in the markets and your particular portfolio, there could be a point in time where your portfolio lands up deviating a lot from your target asset allocation. So please revisit the portfolio and ensure that the needful is done. The ones that have run up a lot are sold, and the ones that have declined, the assets value, the value of certain asset classes that have declined are bought more. So this will ensure that you stick with your asset allocation for a longer period in time. Final bottom line, asset allocation is not a magic pill. The magic pill is discipline. The ability to stick to your asset allocation in a disciplined manner and to continuously refine your asset allocation in light of newer information about yourself and about external environments. So guys, this was an interesting conversation around asset allocation. We spoke about several strategies. We spoke about the key learnings that I've had as a portfolio manager. And I look forward to each one of you building your own asset allocation strategies and your own successful portfolios for yourself and your loved ones. Happy investing. Have a great time.